Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. Today we'll be looking at the differences between growth investing and dividend investing. I'll go through the tax implications of both strategies, as well as the mental benefits around the different strategies. I do want to emphasize that there is no one best strategy. The best strategy is the one that you can maintain for 30 years. Whether that's growth or dividend, it doesn't matter. It's consistency and sticking with your values that will result in the best outcome. At a specific point in time, one strategy might do better than the other, and then it'll flip. Ultimately, they should both have the same or very similar outcome. So what is dividend investing and what is growth investing? This word gets a little vague, and different people and assets can be interpreted differently. If you think about an asset, generally all assets will generate a return. This return can be in the form of income or growth, or a combination of both. It doesn't really matter what the asset is. Let's say asset A has a growth rate of 7% each year, grows by 7% compounded, doesn't pay out any income. So let's say you buy it for $100 today. In 10 years' time, at a 7% compounded return, it's now worth $197. Let's now look at asset B. Asset B pays a dividend of 7%, but the value of the asset doesn't change. If you buy it today for $100, in 10 years' time, it's still going to be worth $100. However, it would have paid you $70 in income, or $7 each year, meaning its final total value, when you add the capital value plus all the dividends, is at $170. These are two extreme but super simple examples, and they're not really representative of what actually happens in the market either, and it's a little bit misleading. In the examples I gave, asset A has compounding, which is resulting in a higher final balance, while asset B doesn't. You can still compound with income, and I'll talk a bit more about that later. Now let's bring in asset C. So if asset C also has a 7% return, but let's say 3.5% is income, 3.5% is growth. Which one is it? Is it a growth asset or is it an income asset? It's both and neither. The definition that I use is that 80% or more of the return generated by an asset needs to be in one of those strategies in order to be called either a growth or an income asset. So if an asset grows at say 10%, it can pay out up to 2% as income and still be called a growth asset. At the same point, an income asset can still grow at 2% a year, still be an income asset if it pays out 8% of its 10% total return. Is one better than the other? No. Each have their own pros and cons, so let's start with growth investing. The first benefit of using the growth investing strategy is you don't have to pay tax until you sell. In Australia, we don't have an asset tax. If you buy an asset for $100 today, next year it's worth $200 and you haven't sold it, don't need to pay any tax. You could hold it indefinitely, but as long as the ownership hasn't changed, there's no sale and therefore no tax. The second benefit is something called the CGT discount. If you hold an asset for more than a year, this is 366 days and beyond. So if you buy on the 1st of January, you'd have to sell it after the 2nd of January the following year. And if you do that, you're able to get a discount on the tax payable of the gains by 50%. So if you bought asset A for $100 and next year it's worth $200, if you sell it, owning it for less than a year, the total gain is $100 and that gets added to your taxable income. If you held it for more than a year though, you can then half the gain. So that $100 now becomes $50, and that $50 is what gets added to your taxable income and taxed at your marginal rate. The cons of the strategy is if you want to draw down on your investment to supplement your lifestyle or maybe fund your retirement, you need to sell. Because the investment is not paying you an income, the only way to get access to the capital within the asset is by selling down the principal. The second con, and probably the one I would consider the most important, is that growth is not guaranteed. Price growth can occur for a number of reasons. The company might be making good profit, or might be part of a meme squeeze play, or it might just be pure speculation. There are a lot of growth companies that are trading at a lower price than they were years ago. They might have a super solid growing business. The market just doesn't like it for whatever reason. When it comes to dividend investing, let's start with the most obvious con. So every time you receive a dividend payment, that is a taxable event. If you're in a 30% tax bracket, for every dollar that gets paid out, you lose a third in tax. Obviously, this will greatly reduce the compounding effect as less and less of the return can then be reinvested. There are three main benefits around dividend investing. The first is that you don't actually need to sell your assets in order to realize some of the profits. Because you are getting an income stream every month or every quarter or every year, depending on the payout frequency, it means that you can use this money to pay for your lifestyle without having to sell your assets. You don't have to deal with the fluctuations of the market and you can still maintain a consistent standard of living. The second is that most stocks or ETFs or managed funds will have the option of a dividend reinvestment plan or DRP. What is this? So the company announces a dividend. You can take that payment as cash or as additional shares in that asset. Now, make sure that you note that this is still taxable. Whether you reinvest it or not, it's just how you receive this income that can be different. So what is the benefit of DRP if you're still paying tax on the income anyway? So if you're in the accumulation phase, you probably don't need that money. So rather than taking it as cash and buying everyday items with it, if you reinvest those dividends, you'll be buying more units in the company or fund, and let's say asset B has a 10% yield. You're getting 10 cents of income for every share that costs $1. If you have 100 shares in asset B, you're making $10 a year in income. With a DRP, you're buying 10 units of asset B each year. This means each year you're able to buy an additional 10 units in the company, which will then be paying you an additional $1 of income each year. And this will compound. So you get $10 of income this year, next year $11, the year after $12.10, and the year after that $13.31. As you can see, you get compounding income returns. You're using the income to buy more shares in that asset, which then pays you more income to buy even more shares, which then gets you even more income, repeating forever. A small little add-on to this is that most companies will also increase the dividend each year. Let's say they pay you $1 per share in year 1, then $1.05 in year 2, $1.11 in year 3, and $1.15 in year 4. So not only would you get more income by buying more shares with the DRP, each share will also be paying you more income. And this is called dividend growth. The final benefit of using a dividend investing strategy is the peace of mind it brings. Dividends tend to be reliable and consistent. Once a company starts paying one, the shareholders start to expect it, and so they will continue it as long as they have the money. And also, like I just said before, they tend to increase it over time too. This means even if the price of the equity stays the same or goes up slowly, it's not the fact you're worried about the most, unlike growth investing, where the capital growth is the be-all and end-all of how you're making a return on your investment. My personal view is that you should be working out what works best for you. The important thing is to stay invested in the market. If getting reliable income is what's important, then that's what you should be considering more. If you're more focused on the longer term and you're not bothered by the fluctuations in the market, and you don't want to add to your income in the short term, then growth investing might suit you better. I personally prefer something that does a mix, something with a yield of about 3 to 4%, so you get a good income generation that you're then able to fund an early retirement, without drawing down the principal, but also not too high of a yield, that's 100% income, and that still there's some capital growth. So that over time, when you do eventually sell, you get the benefit of a capital gains discount. Hopefully, I've been able to give you a better understanding, of the differences between investing for growth and dividends, the pros and cons of each strategy. If you have any more questions, please feel free to drop a comment below, and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.